Q3 GDP sharply beating expectations, coming in more than double the previous record set all the way back in 1950. What's your reaction to today's report?
It was a great report. The details actually were even better. Consumer spending was up 41%. Investment spending, private investment spending was up 83%. Housing was booming. Auto output was up almost 1,200%. I mean, these numbers are purely staggering. And we haven't rebuilt inventories yet. Actually, they weren't really a big factor giving us a positive outcome. And that's still ahead of us, meaning we have to really replenish depleted store shelves, dealer lots. And that's going to lead to a lot more production and a lot more hiring in the months ahead. And that's really good for U.S. households and certainly for U.S. income creation.
And when we look at the second quarter, GDP did contract more than 31% in those 3 months, then expanding more than 33% here in the third. We're, of course, not fully recovered yet, but that is arguably a V-shaped recovery. With coronavirus cases rising now in several states, though, Americans are facing the possibility of more restrictions, new shutdowns. How would that impact this recovery moving forward?
We'd argue right now, given the fact that the breadth of the gains I was highlighting have been so robust, and leading indicators of the economy, such as housing and autos, are pointing so much higher, that we're in a self-feeding, a self-sustaining recovery. And on the medical side, especially therapeutic news, which recently has come out, is very, very positive. So while we're watching the cases quite closely, the economy looks very healthy, and it seems that it will continue to expand at a very fast rate, as the president suggested. And we're on track, really, to recoup that pandemic-related loss of output, perhaps early next year. So again, the economy looks great. We were saying it would be the case, and now the numbers certainly bear that out.
In looking at other economic data that we got today, we got some new employment data from the Labor Department. New unemployment claims falling to a 7-month low. Stimulus talks at this point are totally deadlocked. No potential relief for a deal before the election. Larry Kudlow says stimulus not actually necessary to continue on with this recovery. What's your take on that?
Director Kudlow is exactly right. The savings rate last quarter was around 15%. Households are getting very strong income growth, about 5% based on the latest employment numbers. They've got high savings to draw down from. We've seen record wealth creation, and therefore there's a lot of good things that are happening to keep this economy moving in a very positive forward momentum direction. And of course, that inventory story is part of that. Having said that, we know that there's still a lot of hardship and pain out there. There are a lot of families that are suffering, and that's why the president so wanted a deal and why he used executive order this past summer to get people as much help as legally he could do. And it's unfortunate that the Democrats haven't met us midway. But again, we'd like to help if we can. But the good news is that at least the economy is performing the way we thought it would, and the Trumpian economy is back. And if these policies continue, I'm very confident that 2021, as the president said, will be just a fantastic year, especially as we make more progress on the medical side. The medicine is going to catch up with this V-shaped boom.
Talking about 2021, we're looking at the fourth quarter, likely to see another big GDP number and expansion in the fourth quarter. Of course, not as big as the third. But when we look at 2021, what type of recovery are you expecting to see as we move through those first probably 6 months of the year?
Housing and autos will continue to be big drivers. Housing, for example, is a very important part of the economy. It pays a lot of good, high-paying jobs. And what we see right now, given basically a 14-year high in home sales, we've seen inventories at record lows. We haven't seen these sort of inventories for housing since the very, very early 80s. So you're going to see a lot more housing supply come on the market, and there's a huge multiplier associated with that. In other words, when you buy a home, you've got to put appliances and furniture and consumer electronics, and then you've got to service the property. So there's a lot of other economic activity that's tied to it. So housing will do very well. We saw earlier this week the durable goods numbers basically recovered all of their pandemic-related losses. That speaks volumes about what should be a very robust capital spending outlook. And when capital spending picks up, hiring goes with it. So really, as I was saying earlier, this is why you get this is how business cycles work. It becomes very self-sustaining. It's a virtuous circle, assuming, of course, that the policies that allowed this economy to do very well up to the pandemic and which have been in place post-pandemic persist. If we're talking about record high tax increases and job-destroying business regulation, then we're not going to get the story that I just am laying out for 2021. But it'll be a very good year for growth. It'll be broad-based with all sectors basically participating.
All right, Joe Lavorgna, the chief economist on the National Economic Council, joining us to discuss the third quarter GDP report. Thanks so much for coming on the show today.
Want to see more videos like this? Visit OANN.com for immediate access to all the clips you've been waiting to see.